This presentation looks at portfolio analysis and in particular the Boston Consulting Group matrix. The Boston Consulting Group developed a matrix that enabled an organisation to assess its product portfolio, or in the case of a conglomerate organisation, its business units, in terms of market share and relative market growth. The relative market share is assessed by taking your market share and dividing it by the nearest competitor's market share. In simple terms, if the result is greater than 1, you have a relatively high market share, and if less than 1, you have a relatively low market share. If the market share is difficult to obtain, it may be possible to ascertain the level of sales and to use a sales figure instead of the market share. The rate of market growth can be ascertained by taking the growth in market sales of this year, that is, this year less last year, and dividing it by the last year's sales. This assumes that you can ascertain what the market sales value is. If in doubt, your sales could be used as a proxy figure, but this assumes that your organisation's sales have been growing at the same rate as the market. The Boston Consulting Group assigned categories to each element of the matrix. Those with a low market share but high growth rate were defined as question marks. Those with a high market share and high growth are classified as stars or sometimes rising stars. Those with a high share and low growth are cash cows, and those with low growth and low market share are classified as dogs. If the products or business units are mapped on the grid using a circle, which represents the size of the product in terms of sales, we can assess the balance of the portfolio visually. This is one of the advantages of the BCG Matrix in that it can provide a visual representation of the product portfolio. Various strategies can then be determined that are suitable for each category. Question marks require investment to build the market share. They carry a high business risk, so getting the product launched and marketing correct is critical. Once the question mark has gained market share and moves to be a rising star, it still requires investment as the market is still growing. If the investment stops, there is a danger that competitors who were attracted to the market due to its growth will capture the market share and your market share will slip back. When the market slows and the market becomes mature, if you have managed to retain the market share, the product can become a cash cow. The basic strategy is to hold the product in this position by retaining interest in the product and retaining the market share. These products provide the cash in which you can invest in new question marks and rising stars. If the cash cows become a weak cash cow, perhaps because of new technologies or changes in the market conditions, a strategy to harvest can be adopted. This might involve selling off old stock at a discount, but once the product is harvested, a new product must be planted to replace it, hence the need for a balanced portfolio. Products that have a low market share and low growth may become a drain on the resources and could be divested in some way to release the resources back to products with more potential. However, don't underestimate the dogs, as they can often still be very profitable in a niche market as long as they do not drain resources from the overall company. As we have seen, the idea is to develop a balanced portfolio so that as cash cows lose their market share, new products can come through to replace them. There are stories of pharmaceutical companies that have merged on the basis of creating a strong portfolio of products. One had strong research and development capabilities and was good at developing new products, but was not very good at marketing them. The other was good at marketing and had cash cows, but very few new products coming through. So joining them together created a much stronger company. We can also assess the potential impact of using different strategies within the portfolio. For example, investing in one product over another where the resources are scarce. And as the strategies are developed, it is possible to see if market share has increased Or has investing in one product over another had the desired effect, so we can assess the trends over a period of time. As you are assessing your relative market share to competitors, it is possible to gain a view of the competitor's portfolio as part of competitor analysis. As with all strategy models, there are some aspects to be aware of when using them. For example, within the Boston Consulting Group matrix, there may be complementary products that are missed in the analysis, so we could be missing potential synergies between the products. The analysis can also send a message that the objective is high market share at all costs, when in fact that could be achieved by selling products at a loss, and hence does not help the profits. And where companies have very large portfolios of products, it could mean that high volumes of data are required, particularly if you consider that you need the competitor market share as well. New technologies today help with this aspect, but it may be prudent to map the key brands on the grid rather than every single product. This video is part of a series of short videos that explain specific aspects of the strategic management framework and cover some of the strategy models that can be used in the analysis, formulation, implementation and review and control of strategy, and the role of the management accountant. This presentation is provided as part of the support materials for the book Management Accounting in Support of Strategy by me, Graham S. Pitcher, and published by Business Expert Press.